Hey, what's going on, everybody? It is Thursday, December 23rd. Yeah, coming up to Christmas. All right, new all-time record high in the S&P 500 today, folks. I told you back right before the Fed meeting. When was that? December 16th. I said if you get a negative outcome out of that, people freaking out over, Fed talking about taper and maybe some rate hikes, you got to buy into that pullback. Those things, like I've been telling you, are completely misunderstood by analysts and investors and even, the mainstream economics profession. They just do not, they have it backwards. It's not even that they don't understand. They have it backwards and they stick with that backward interpretation. And so it sets up opportunity. So there you had it. As I've been telling you, conditions are benign for the stock market. Conditions are supportive for the stock market. The key thing here are those fiscal flows. And they are not, they've moderated a bit, as I've been telling you, but they're still quite high, at least 20% higher than pre-pandemic levels. That's, in my opinion, in my estimation, that's enough to sustain a 2 to 3% growth rate, maybe higher, but at least a 2 to 3% growth rate. The Omicron is a little bit of a problem right now. It's spreading rapidly. Fortunately, we don't see the lethality that we saw, or that we're seeing, I should say, in Delta and the original strain of COVID-19. So that's a good sign. You're really not seeing a spiking death rate. So that is a very good sign. But as far as the fiscal flows are concerned, like I said, that's a 2 to 3%, maybe a little bit higher GDP growth rate. That is a good environment for stocks. Traditionally, historically, that has been a good environment for stocks. Your corporate profits are going to grow. Stock market's going to go up, maybe not on a, like a parabolic move or straight linear move like we had during, the really heady days of stimulus after stimulus, but that's a good level of spending and it's going to be positive for the stock market. So the key thing, I think, we'll see early next year what the flows look like, but again, I don't anticipate a significant reduction from these levels because you need to cut really the four main things, which is Social Security, Medicare, Medicaid, and defense. And those things are just not going to get cut. And those are the four big spending items that support most of spending. So you have that going on. That is very positive. Next year, and we got plenty of time to talk about this. It's not even really worth mentioning right now, but I will. Those Fed rate hikes. Now, I'm the only one who's been telling you that rate hikes equate to price increases. The cost of credit is reflected in the cost of all goods and services. You raise the cost of credit by raising interest rates, and that trickles through the economy as higher prices. And that is, opposite of what the Fed thinks it's trying to achieve. Luckily, because we're going to have a slower growth rate, in the 2 to 3%, maybe 3 to 4%, I don't know, range, that will help to bring prices down. So luckily, while the Fed is jacking up interest rates, which is jacking up prices, we're going to have an offset because the economy is slowing down a little bit and because we're going to see some relief with these supply chain issues. That will mitigate the price increases that the Fed will be putting through as a result of the rate hikes. Now, everybody thinks rate hikes squash inflation. They don't squash inflation. You can go back to the Volcker period when he was jacking up rates like every freaking month, and you could literally superimpose a chart of inflation right over those rates until he created a demand shock. In other words, prices got so high that incomes couldn't keep up with those prices. Prices started to fall, and then he started to cut rates, and that's when inflation really started to drop way, way down. But while he was putting the interest rate up, He was creating this inflation spiral. Volcker. Unbelievable. So we'll see what happens next year with that, but we still have a long way to go on before at least a few months. I don't know. I don't anticipate the Fed doing anything until March, but we'll see. But for now, things are looking good. Sentiment-wise, it's another thing I touched upon. I mean, we had a lot of negative sentiment, so the conditions, the market psychology conditions were very conducive to a rally. I mean, we got some really, really high levels of bearishness, levels that I haven't seen in a long time. And, that was like a powder keg waiting to go off, in a bullish way, because everybody was super bearish. And, the Fed and inflation and, rates are going to go up and this and that and taper. And oh my God, right? Everybody was freaking out. I mean, I love this stuff. I love when this happens. And vice versa. When it gets really, really bullish and optimistic, then, okay, you take some money off the table. But I did a lot of buying in this pullback. And there's still sectors of the market that are very, very attractive. I've been sending out recommendations to my subscribers. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. There, by the way, there is if you're an individual subscriber, I have a special rate. Send me an email, mnorman@pitbulleconomics.com. I could sign it up at a lower rate, not the institutional rate, which I know a lot of you are complaining about. But look, it's my service. I could charge what I want. And nobody's obligated to subscribe. And you get a 30-day free trial. Nobody's obligated. I'm the only one who does this. This is applied MMT. Like I say, practically every video I make, there's plenty of academics out there, and it's great to have them, and they're writing papers, and they're giving speeches, and they're talking about MMT theory, and that's fantastic. I bring 40 years plus as a trading background, a member of 4 different exchanges, a floor trader, and an economist, and I meld the two things together. The MMT perspective gives you an edge. Plus the things I look at, daily treasury statement, those flows, like nobody's talking to you about this stuff. I'm the only one talking to you about this stuff. Hang on. New York, baby. So yeah, that's where we're at. And again, I just want to end off by saying I'm watching this Russian-Ukraine NATO situation. Putin said today, and it was announced that the U.S. and Russia will enter into some security talks early in 2022. So that's good. Maybe we'll get some deconfliction going on here, and we really need it because this is a tense situation. And if you listen to some of there's a lot of video because Putin just gave his big end of the year media conference, and there are a lot of great sound bites. I mean, you should listen to what he's saying. I mean, he's very serious now for the first time. Like usually Russia, they do nothing, they get pushed, but then it comes to a point. I mean, read the book, The Siege of Stalingrad. I mean, it's incredible what these people went through and how they turned the tide against Hitler's army, the Third Army, which was their most powerful army in Hitler's military, and that battle was instrumental in turning the tide against the Nazis. And it's incredible what the Russian people went through, how they fought. So I mean, this time he's really serious, man. And look again, I try to explain it in terms of if Russia or China or Iran were putting missiles on the border of Canada and Mexico, nuclear armed missiles, nuclear capable missiles, right on our borders, the United States would not sit by and allow that to happen. I can assure you of that. So it's a tense situation, and I really hope it can be resolved, because we don't want to have that. We don't want to have that, believe me. So that's it. I'm wishing everybody, I'll probably make a video tomorrow, but for now I'm wishing everybody a Merry Christmas, Happy Holidays. Next week is New Year's. The year went by fast, man, but it was a good year. I know a lot of people have been sending me emails that they were grateful for the guidance and stuff like that, and it's just what I do, man. So enjoy, everybody. See you tomorrow. Bye.